అదేంటి మేడం లేకుండా మేము ఎదురు పెట్టవచ్చు. నేనెందుకు రిపోర్ట్ అందరూ వస్తున్నారుగా మనకి నేనెందుకు రిపోర్ట్ చేస్తానా?
Good morning, everyone. Am I audible?
Yes, ma'am.
Yes,
Yeah.
ma'am.
Sorry for being late. I had huge login issues with Zoom. It was creating a lot of problem. Right. So only 23 have logged in. Right. So slight change in schedule. We were supposed to have a day off today, but we're covering your last domain class today, which is regulatory, environment, and risk management. And just a fair warning, today is a bit of a dry topic, so I'll try to make it interesting, which is going to be a little difficult, but we'll try. Right, how was the mocks?
It was good, ma'am.
It was good. What about the rest of them? Not good.
It was good.
Ma'am, they were better than the last time.
Yeah,
Yes,
so
ma'am.
some of you did improve from your last time's mocks. Some of you didn't, and people who didn't, and I'll publish this course today. You really need to start working hard for your final mocks. You just have one more week left. Next week, you'll be having your presentations and stuff. And then the week after that, you'll be having your final mocks. You have one more week to start preparing really hard for your final mocks. For those of you who haven't cleared, you need to at least get a 3 out of 5 in order to be eligible for placements. Is this clear to everyone?
Yes, ma'am.
Yeah. If you don't score a 3 out of 5 in your final mocks, you will not be in the pool. Even if, let's say, a grade book says that you've gotten tier 3, tier 2, whatever. But if your final mock score is not 3 out of 5, you won't be in the pool. I'm making it abundantly clear to everyone. Is this clear?
Yes, ma'am.
Yes, ma'am.
Right?
Yes, ma'am.
Now, if you don't get a 3 out of 5 in your final mock, you just get one more chance of a remock, which will be arranged usually 2 weeks after your final mocks to give you time to prepare again. And that will be just one last chance to clear the mocks. Is this clear?
Yes, ma'am.
Right. Okay. So if we okay, can we start off today's session then?
Yes,
Okay,
ma'am.
ma'am.
Okay. So today's session, we are going to learn about regulatory environment and risk management. So basically, we are going to cover some of your important regulations and some of your important regulators that came into picture. So what's a regulator? By now, you should be able to answer this question. What's a regulator? What's a regulator, folks?
They are appointed by
Authority.
government and they monitor the activities of the financial market.
Yeah. So regulator are bodies that are established by government or other organizations to oversee the functioning of the financial markets and the firms that engage in financial activity, right? So the goal of regulation is to prevent or investigate fraud, keep markets efficient and transparent, and make sure the customers and clients are treated fairly and honestly. Now, some of your regulators are your, SEBI, Fed Reserve, SEC, FCA, IRDA. Now, most of the times in the mocks, when I've asked regulators' name, people have stuck to just telling me Indian regulators. Hardly any of you gave me regulators from other countries, right? So write down this para. So if the regulations are not followed by the market participants, what happens? Fines, reputation damage, even jail time, right?
Yes, ma'am.
Okay, so write this down. Done?
Ma'am, just a
1
minute.
minute, ma'am.
Sure.
Done, ma'am.
Okay. So one of the most important regulations that was passed post your 2008 crisis
Ma'am, can you
was,
please scroll down for the
scroll up or scroll down?
scroll up? Thank you, ma'am.
Okay. So one of the important regulations that was passed in the US after your 2008 crisis was the Dodd-Frank Act. You all know what happened in 2008 now, right? Yes or no? Yeah. It's the bad housing market, along with creating or securitizing mortgages and creating mortgage-backed securities, and then putting a CDS on the top of it. It caused when the market crashed, or when the housing market crashed, it created a very big recession in the US, right? Suppose that during your Obama administration, who is Obama, by the way? Who's Obama? Former president of the US, right? Yeah.
Yes, ma'am.
So
Yes, ma'am.
during his administration, they came up with the Dodd-Frank Act, right? So the Dodd-Frank Wall Street Reform and Consumer Protection Act, or commonly referred to as Dodd-Frank Act in the United States, is a United States federal law that was enacted on July 21st, 2010 during the Obama administration. So why this was created? Because after the 2008 crisis, the regulators and all realized they need to create or recreate the reforms and policies in the regulatory environment in order to give, or rather give, more transparency, and also to put a tighter key on your financial participants so that they don't misuse the investors' money, right? So some of your key reforms that came out of your Dodd-Frank Act was, one is consolidation of regulatory agencies. So instead of having multiple regulatory agencies, have a single consolidated one. That was one. Are we clear with this point?
Yes, ma'am.
Okay. Then comprehensive regulation of financial markets, including increased transparency of derivatives, meaning trying to make it more regulated by bringing them onto the exchange. The main cause of your 2008 crisis was a credit default swap, right? Which is an OTC product. Agreed?
Yes, ma'am.
Yeah.
Yes, ma'am.
So we know that with exchange, the default risk is very low because we maintain margins, correct?
Yes, ma'am.
Yeah. So what they're trying to do is now maybe come up with a way to bring derivatives or your OTC derivatives onto the exchange in order to reduce the default risk, right? Then increase in consumer protection reforms, meaning creating new reforms that will cover the investors in case of such event that happens again, right? Tools for financial crisis, including a resolution regime which complements the existing existing Federal Deposit Insurance Corporation Authority to allow for orderly winding up of bankrupt firms, including proposal that the Fed Reserve receives authorization from the Treasury for extension of credit in unusual or extingent circumstances. The gist of this paragraph, because this is like all big words. Prior to year 2008, the FDIC had a reform in place that would help your financial participants, especially your big banks, in case if they were headed towards bankruptcy or anything, they would bail them out. Remember, we talked about Lehman. Before Lehman, there was a smaller bank that was going to go bankrupt, and then the Fed Reserve gave JP Morgan money to acquire that bank. You guys remember that? Yes or no?
Yes, ma'am.
Yeah. So there was already a reform in place, but after the 2008 crisis, they added another reform with the existing FDIC reform, saying giving the Fed Reserve. Who's the Fed Reserve? The Central Bank of US, right?
Yes, ma'am.
Yes,
Yeah.
ma'am.
The authorization to give credit, meaning give money to any banks for any unusual extingent circumstance, meaning like example of your 2008 crisis, right? So after your 2008 crisis, actually, the Fed Reserve came up with something called as Trouble Asset Relief Fund, which was when they injected money into the banks, your all big banks, your captives like your G, Morgan Stanley, etc., and all of that, to help them with the, to recover from the 2008 crisis. But they had put a, what do you say, criteria on that. They were saying to bring back all these outsourced jobs that these banks had outsourced to India or Asia. That time there was a big tension whether people working in the Asia and Asia offices, whether they'll have a job or not. Right? Are we clear with this point?
Yes, ma'am.
Okay. Then increased regulation on your credit rating agencies. So one of the participants that also caused, or rather was one of the reasons also why the 2008 crisis happened is, remember that part of securitization where they split the securities based on the underlying credit rating of the mortgage holders.
Yes, ma'am. Prime and subprime.
Exactly. So what happened is this credit rating agencies, even if they knew that the underlying mortgages were subprime, on the mortgage backed security, they gave like a triple A or triple B rating, which is false, right? Yes or no?
Yes.
Yes, ma'am.
So what happened is the Fed Reserve started putting tightened this thing on your credit rating agencies, because these guys knowingly they gave an incorrect rating. Is this clear?
Yes, ma'am.
Yes.
Okay. And then one more important rule was added on the Dodd-Frank Act, was something called as the Volcker rule. If you guys remember, when you watch that crisis of credit video, that green color video, remember?
Yes.
Yes, ma'am.
In the beginning of the video, you saw parts that talked about leverage, correct?
Yes, ma'am.
Yeah. So what investment banks used to do, they used to take their own money that they earned from services that they provided, and they leverage that money in order to make more profits. So or in other words, it was also called as proprietary trading. Remember when the investment bank takes its own money, invests in the market and makes more money for themselves? You
Yes,
remember
ma'am.
that?
Ma'am.
Yeah.
Yes, ma'am.
So Walker rule now says that these banks are not allowed to do proprietary trading of the entire money that they have. Like if I have to put it in context, let's say I am GS. I gave a service to a client, and let's say I got paid $1 million. Now, ideally, I would take that $1 million, give it to my proprietary trader, and tell him to invest the entire money in the market to make more profits for me. Correct?
Yes, ma'am.
Now with Volcker rule that has come in, it says 3% of that capital, meaning 3% of 1 million only I can invest in the market. I cannot invest more than that. Is this clear to everyone?
Yes.
Is this clear to everyone? Yes or no?
Yes, ma'am.
Okay. So write down what is Dodd-Frank Act.
Ma'am,
Yes.
so basically they can invest only 3% of the amount back.
Yes.
Okay, ma'am.
Of their earnings, not more than that. Because what these guys did is they basically knew that the market was this thing, so they leveraged their money and they made nice profits. But
Okay,
who
ma'am.
got the brunt of it was the clients, right?
Yes, ma'am.
Okay, so they're trying to put a stop or trying to put a, what do you say, cap on how much they can invest. Okay.
Okay, ma'am.
Let me know once you finish writing. Yeah.
Yes, ma'am.
Done?
1 minute, ma'am.
Sure.
No, ma'am.
Done, ma'am.
Everyone's done?
Yes, ma'am.
Yes,
Okay.
ma'am.
So let's look at the next one. So Basel is actually a committee which was initially called the Banking Supervision Committee, or Committee of Banking Supervision, which is BCBS, which is set up in 1974 in Basel, Switzerland. That's why it's called Basel, or sometimes they say Basel as well. So it's an international regulator for banks. As we know, banks may not be just present in just one country, they can have branches all over the world, right? Yes or
Yes,
no?
ma'am.
Yeah. So what happens is they needed an international regulator for banks as well. So Basel was formed. So they came up with their first accord called as Basel One, and the general purpose of that, which was formed in 1988, or rather the general purpose of the first Basel Accord that was published, was just strengthening the ability of the international banking system. If you backtrack a couple of years ago, for us to transfer money from India to abroad would have been difficult, right? But now it is what? As simple as logging onto your internet banking and initiating the transfer, right?
Yes, ma'am.
Yes, ma'am.
Okay. Then in 2004, Basel II was published. So Basel II had three pillars. One was minimum capital requirement addressing risk, right? So what is capital requirement? It's a regulatory standard for banks to determine how much liquid capital they must keep on hand. Can you correlate this to something that we learned in our money markets class?
Yes,
What?
statutory.
Gains, no,
CRR.
CRR, exactly, the cash reserve ratio, right? And the second pillar was supervisory review, which was in terms of the transactions that happened, the regulations. Like to put it in simple case, we discussed about your cash transaction report in India. RBI says anything greater than 50,000 needs to be reported to the RBI, right? Yes or no?
Yes, ma'am.
Yeah.
Yes, ma'am.
So supervisory review and market discipline, in a sense that we know banks, when they get deposits, they will not sit idly on it. They will try to reinvest it. Correct.
Yes,
Yes,
ma'am.
ma'am.
Yeah. So some sort of market discipline in where they invest, how they invest, because they need to have some sort of backup in case if their investment goes wrong. Ultimately, whose money that is? That is the customer's money they're investing, right?
Yes, ma'am.
Okay. Are we clear with what is Basel II?
Yes, ma'am.
Okay. In 2009, then they published Basel III, which was created and is a global voluntary regulatory framework. So it's not a compulsory thing for the bank, it's a voluntary thing. And the importance in your Basel III was capital adequacy. So what is capital adequacy? Is a ratio of the bank's capital to its risk, right? So, and then to conduct something called as stress testing and market liquidity risk. Market liquidity risk is simple. If the bank is owning any assets or invested in securities, how liquid is that in case if something happens? Can they sell it and get cash for it? Are we clear with this bit?
Yes, ma'am.
Yes,
Yeah. What is stress testing? Stress testing, to put it in example, when you guys join now companies, right? One of the things you'll notice is they will have something called as fire drills. Have any of you heard of these? No. So what is a fire drill is they simulate like a fire. They don't actually light anything on fire, but they'll on the fire alarm. And when the fire alarm goes on, you will see people orderly walking out of their workstations, taking the stairs and collecting at a point. There's no actual fire that has happened, but they do this drill for what reason? Why do they do this drill?
In case there is actual fire, that would
Exactly. Exactly. In case if there's actual fire, they know what are the protocols and what are the procedures and steps to follow. Correct? Yes or
Yes,
no?
ma'am.
Yes.
Yeah. So stress testing for banks would be in case if there is a very adverse situation in the market, like your 2008 crisis, will the bank be able to handle such a crisis? Do they have enough capital and reserves? Will they be able to cover their losses? Are we clear with this?
Yes, ma'am.
Yes, ma'am.
Okay, so Basel III's main focus is to strengthen the bank's capital requirement by increasing the bank's liquidity and decreasing the bank's leverage. So preventing these guys from reinvesting all of the money in the market. Is this clear to everyone?
Yes, ma'am.
Write this down. Done?
No, ma'am.
Done now?
Yes.
Okay. Next one
Just a
is-
moment, ma'am.
Sure.
Done, ma'am. Thank you.
Right. So next is your Egmont group. You remember what are FIUs?
Yes, ma'am. Financial intelligence unit.
Correct. So financial intelligence unit, which was one of the recommendations that the FATF gave, was every country needs to have its own financial intelligence unit. So Egmont group is nothing but the collection of your FIUs of different countries. So they were established in 1995, the Egmont group. It's a collection of your financial intelligence units. It consists about 127 member countries, right? The purpose of the Egmont Group is to provide a forum for your FIUs around the world to improve the cooperation in fight against your money laundering and financing of terrorism, and to foster implementation of domestic programs in this field. What is domestic programs in this field is meaning putting procedures or controls in place to identify money launderers or people who finance terrorist activities. Is this clear?
Yes, ma'am.
Yeah, write this down.
Egmont group can be same as FATF. no?
No. FATF was formed 1989. That was it came forth from the G7 summit when they recognized that money laundering was a big problem globally, right? Once FATF was formed, then FATF recommended that every country should have its FIUs. Yeah.
Okay.
After that, what happened is the FIUs came together and formed Egmont Group. So this would help them to even pass on information, or if new money laundering techniques are detected in their country, they would publish it to the Egmont Group. Then from there, the other member countries also can see these new methods and maybe figure out if anyone in their country is doing that, right?
Ma'am, one more thing. We have compared previous law with CRR, but in CRR only 2 to 3% of the funds should be kept with RBI. But in this case, only 2 to 3% of fund they are allowed to reinvest in the market.
Not in this thing. We're talking about when Volcker rule states that 3% of their tier one capital. Don't confuse your proprietary trading versus your commercial banks and your deposit accepting banks. So the key difference is, let's say if I'm a commercial bank, the number of amount of deposits that I get will run in easily in crores, right? Because my clients are corporates and institutions. Yeah.
Yes, ma'am.
Now, out of the deposits that I get, I'm not going to sit idly on it. I can reinvest it, correct?
Okay, ma'am.
Okay. So what is your CRR and SLR is your central bank saying that those deposits that you get, you cannot invest the entire thing in the market. A certain percentage of it needs to be kept aside. Are we clear with this bit?
Yes, ma'am.
Okay. Now your Volcker rule, what it states is, again, let's backtrack to the same example. If I'm a commercial bank, I do provide some services for my clients, right?
Yes, ma'am.
So when I provide this service, I get paid some sort of performance fee or service fee or something like that, correct?
Yes, definitely.
Yeah, so that money that I earned by providing that service, that money ideally I can reinvest the entire money in the market however I see fit because it's my own money, correct?
Okay, understood, ma'am.
Understood now? So
Yes.
Volcker rule is saying that that money also now the entire thing you cannot reinvest, 3% you can reinvest. Okay?
Yes, ma'am.
Finish writing, folks?
Yes, ma'am.
Everyone's done?
Yes,
Just a
ma'am.
minute. Done, ma'am.
So let me continue then. The next one we have is Wolfsburg Group, right? And this was formed in 1999, and it's a non-governmental association of 13 global banks. And what these guys do is they come together to create frameworks or policies around your AML, KYC, and counter terrorist financing. So they kind of work similar like your FATF, but FATF does it on a worldwide basis, global basis, right? Yes or no? Yeah. These guys do it more as a domestic on the bank level. Is this clear?
Yes, ma'am.
So other than that, they also are a collective action group to, if there is any corruption in the bank, scams, etc., they come together in order to figure out what to do or, sort out the issues relating to that particular scams and all. Now, the list of 13 banks are given below. And ironically, if you see all of these guys, we know this guy paid a big fine for not complying with AML KYC procedures, right? We discussed this in AML KYC class. Remember?
Yes, ma'am.
Yeah. If you see all of these guys, no, I guarantee one or the other guy definitely throughout their history have paid a fine for not complying with AML KYC procedure. And ironically, they are the one who sit on the forum to tweak or make the AML KYC procedures more better. Funny bit, right? So are we okay with what's Wolfsburg Group?
Yes, ma'am.
Yes, ma'am.
Yeah, write this down. Done?
No, ma'am.
1 minute, ma'am.
1 minute. Okay. Done now?
Done, ma'am.
Yes, ma'am.
The next one we're going to look at is MiFID, which is one of your important regulators in the European markets. So MiFID stands for Market in Financial Instruments Directive, right? It was a law created by the European Union for the purpose of regulating all investment services in its member states in the European Economic Area. So what are investment services? Like your investment bank providing the services and functions. Is this clear? Or like a hedge fund providing its clients some investing strategies, or a mutual fund providing its retail investors an opportunity to invest. Are we all clear with this?
Yes, ma'am.
Yes, ma'am.
Okay. So a revision of MiFID was done, which was called as MiFID 2, which was rolled out in 2018. And the objective below is it covers the virtually every asset or profession within the European Union that relates to the financial service industry, right? It regulates your off exchange and OTC trading. So basically they regulate the OTC market, and what they're also trying to do is bring them onto the exchange so that it gets more regulated and the default risk gets negated, right? And also increase in transparency of costs and improving the record keeping of transactions is some of your MiFID's two keys regulation. We all know when it comes to exchange market, we place the order on the exchange. The exchange will record our orders, correct?
Yes, ma'am.
Yes, ma'am.
But when it comes to OTC market, is there any central location where these orders are recorded? No.
No.
Why? Because we know the counterparty, we negotiate and we make deals, and then within our systems we record it. But then even if we record it within our system, sorry, just give me 1 second. That can also be what you say fixed, or in a sense we can even put incorrect information, right?
Yes, ma'am.
Yeah. So MiFID 2 basically is trying to make your OTC market standardized in terms of the record keeping and transparent in terms of what all transactions are executed in the market. Are we clear with what is MiFID?
Yes,
Yes,
ma'am.
ma'am.
Yeah, write this down. Done?
No, ma'am.
Done now?
Yes, ma'am.
Yes, ma'am.
Okay. So the next bigger one, this is also pertaining to the European Union, is called as EMIR, which stands for European Market Infrastructure Regulation. And this is more specifically for your OTC derivatives, the regulation, and for central counterparties, and for someone called as trade repositories. Central counterparties, you know who they are now, right? Or what they do.
Yes, ma'am.
Yeah. And what are trade repositories? Trade repositories are basically a centralized location where you record your OTC transaction. So to put it in context, let's say if I'm a bank in the European market and I enter into, let's say, interest rate swap derivative deal, which is an OTC derivative, with another European bank in the European market. Now, since this is an OTC product, normally there is no record outside within our systems that is recorded in a central location, correct?
Yes.
Yeah. So now with the existing of trade repositories, what does this mean? When I make this interest rate swap deal with the other counterparty, I have to go and put this transaction onto the trade repository as a record. Is this clear to everyone?
Yes, ma'am.
Okay, so EMIR was introduced by European Union as an implementation of the G20 committee, where the G20 committee's focus was to reduce systemic counterparty operational risk, right? And what is this systemic and operational risk? We'll discuss in the next topic, which is risk management, and then increase the transparency in the OTC derivative market. Is this clear?
Yes, ma'am.
Yes, ma'am.
And then post year 2008 crisis, it has also designed a preventive measure to avoid the fallout during your possible future crisis, right? It has established common rules for central counterparties. And what are central counterparties? They interpose themselves between parties in a contract to serve as a focal point for each trade. And then the trade repositories to collect and maintain all the records of the trade, right? So email requires reporting of all derivatives, whether OTC or on exchange traded, in the trade repository. Is this clear to everyone?
Yes, ma'am.
Yeah. So it covers entities that qualify for derivative contracts in regards to interest rate, equity, foreign exchange, credit, commodity derivatives. And it also outlines 3 sets of obligations, which is your clearing, reporting, and risk mitigation of the applicable products, which we'll talk about in few minutes. So just on a side note, and make this note somewhere, which is important, EMIR recently passed something called as the CSDR regulation. Remember, we talked about this in your settlements class a bit. You remember? Yes or no? Guys, do you remember this ESDR regulation? Yes or no?
No, ma'am.
Okay, so basically, your CSDR stands for Central Securities Depository Regulation. In the European market, EMIR had published a regulation that from Jan 2022, they would implement mandatory buy-ins. Now, you all know what are buy-ins, right?
Yes, ma'am.
Yeah. Before buy-in, what they used to give them a timeline based on the market, either 3 days after settlement date or 5 days after settlement date, only they can send a buy-in notice. But now, with this regulation, what they're planning to do is make buy-ins mandatory, meaning the buyer wouldn't have to send a notification to the seller in order to execute the buy-in. Is this clear to everyone?
Yes, ma'am.
Yes, ma'am.
Okay, but what happened is they are not they couldn't put it officially in place because the market participants have asked some more time to get used to this aspect, because if they put in buy-ins in place, the short selling will get affected, right? You remember what is short selling?
Yes, ma'am.
Yes, ma'am.
Yeah, you sell something that you don't have with the intention, by the time you have to deliver it, you'll be able to acquire it, right? So to put it in an actual example, if I made a deal to sell shares to you and the settlement date was today, 30, and if I fail to deliver it tomorrow, from tomorrow onwards, it's a failed trade. Now, before this ESDR regulation, you would have to wait maybe 3 days or 5 days. Then you would send me a buy-in notice, and additionally, you'll give me a deadline date, which is a couple of days for me to deliver the shares to you guys, right?
Yes, ma'am.
Yes, ma'am.
Yeah, but now if the CSDR regulation comes into place and mandatory buy-in happens, and if, let's say, hypothetically the CSDR regulation says you just get 2 days after settlement date, that means now if I fail to deliver today, I only have time till 15th. You don't even have to send me a notice. Automatically on 15th, what you can do, if you didn't receive the shares from me, you can go to the market and buy the shares, and if you pay more than the agreed price, I have to pay you the difference, correct?
Yes, ma'am.
Yeah. So the market participants asked for an extension. So as of now, the mandatory buy-ins are not in place, but they have implemented something called as the CSDR penalties. So what are these is, every day a trade fails now, the seller would have to pay a certain penalty amount. Is this clear to everyone?
Yes, ma'am.
Okay.
Yes, ma'am.
So write this down about EMIR, and then we'll talk about what are the set of obligations that are there. Done?
Yes, ma'am.
Everyone's done?
Yes, ma'am.
Okay. So let's look at some of the key this thing. So EMIR was designed around three obligations that they want all of the financial service participants in the markets to follow, right? So one of the key aspects is must report every derivative contract that they enter into the trade repository. They also must implement risk management standards, right? Including operational processes of margining related to bilateral OTC derivatives. What is margining related to bilateral OTC derivatives? In simple words, is using CCPs. So when you use a CCP, what is the criteria? You have to maintain sufficient collateral as per the trade that you're executing, right?
Yes, ma'am.
Yeah. So counterparties must file reports wherever they enter into derivative transactions within the European area and outside. So let's say if I'm a European bank entering into an interest rate swap with another European bank, I have to report it. Also, if let's say I'm a European bank entering into an interest rate swap with the US bank, I still have to report it. Is this clear?
Yes, ma'am.
Okay. Also, vice versa. If it's a US bank that's coming into the European market and entering into, let's say, an interest rate swap derivative with any other bank, they also will have to report it to the trade repository. Is this clear?
Yes, ma'am.
Okay. So let's look at the clearing aspect. So the European Securities and Markets Authority, which is ESMA for short, applies mandatory clearing obligations to specific OTC derivative contracts if the contracts have been assigned a central counterparty under remit. So if you use a CCP, the settlement has to be guaranteed. Is this clear? Okay. Also, it obligates your financial participants who want to enter into OTC derivative deals have to use the CCP. So one of the condition is if you're going to do OTC derivative deals, you have to use a CCP, which would then imply as a participant, you have to keep sufficient collateral at the CCP as well, right?
Yes, ma'am.
Yes, ma'am.
Okay. So this obligation is for your any financial participant like your banks, insurers, managers of assets, or even non-financial counterparties. Have we clear till here?
Yes, ma'am.
Yeah, write this down. Done?
No, ma'am.
Deepika? Deepika, you there? Deepika Bindu, you there? Can't hear you. Check your audio setting. I asked you a question on the chat. Can you respond to that, please? Finish writing, folks?
Yes, ma'am.
Everyone's done?
Yes, ma'am.
Okay.
Ma'am, 1 minute.
1 minute. Okay.
Done, ma'am.
Is the reporting and risk mitigation, right? So, as email states that every trade needs to be recorded at the trade repository, every financial participant would record their trade under the trade repository, would have a unique legal identity or legal entity identifier, and every transaction that would record, it would have a unique transaction identifier, or LEI and UTI for short. Is this clear to everyone?
Yes, ma'am.
Yeah. So when these mandatory reports that are sent or it's recorded under the trade repository, so the information on the trading capacity of the counterparty, the mark-to-market valuation of the position, all of this is also recorded. Are we clear what falls under reporting?
Yes, ma'am.
Yeah. Then risk mitigation. So one of email's central purpose is to manage and avoid systemic risk. What is systemic risk? We'll discuss next. EMIR and other legislations like it aim to reduce systemic risk in part by increasing the regulations on clearing and trading and settlements. And under EMIR, the risk mitigation regime applies to contracts involving both EU countries and over-the-counter derivatives involving third country entities. Like that example that I gave you, if a US bank also wants to execute a deal in the European market that is related to an OTC derivative, they would also have to comply to EMIR's regulation. Is this clear?
Yes, ma'am.
Yeah.
Yes, ma'am.
So the risk mitigation standards are outlined by EMIR's Article 11. You don't have to look it up or mark it. It is fine, not required. The other risk mitigation techniques defined by EMIR include timely submission of reports and confirmation of adherence to the regulation by all counterparties. And other techniques involved is a new dispute resolution process, daily market reports, and exchange and public exchange of collateral between parties. So basically risk mitigation is all your financial participants, one should ensure that they comply with the email regulations. They should ensure that they provide the timely reports that are required by email, which would include their risk mitigation techniques. What is the collateral they have? What is the valuation of the collateral? Any risk they might face? How are they going to cover that risk, etc. Is this clear?
Yes, ma'am.
Okay. So write this down. Is everyone back?
Yes, ma'am.
Okay. So the next regulation that we'll look at is called FATCA. This is usually pertaining to US citizens. So FATCA stands for the Foreign Account Tax Compliance Act. It's a law that requires US citizens living in the US or abroad to file annual reports on any foreign account holdings they have. So this act was passed in 2010 as a part of the Hiring Incentives to Restore Employment Act, which is designed to promote transparency in the global financial sectors. FATCA requires, like I said, US citizens to file annual reports on any foreign account holdings and pay any taxes owed on them. The criteria is if these foreign accounts hold anywhere $50,000 and above, then they have to report it. If they don't, there are steep penalties charged on it, right? Why is the reason this factor is put in place? Can you correlate it to something in your AML KYC class? Have you understood the question, or have you understood what is FATCA?
Yes, ma'am.
So FATCA basically means if you're a US citizen, if you have accounts outside the US country, which you can hold bank accounts in other countries as well. If you're holding any foreign accounts, anything greater than $50,000, you have to report it to the regulator. Why?
Ma'am, to avoid money laundering, like
Correct.
offshore accounts and
Avoid money laundering. One of the methods we talked about in your money laundering stages in placing is opening offshore accounts, right?
Yes, ma'am.
Yeah. So this is the reason why FATCA has been put in place, right? Now, some of your banks and all are not happy with this FATCA rule because it will then involve disclosing what are their clients' holdings, right? Now, if some clients may not be comfortable with this rule, correct?
Yes, ma'am.
Yeah, so it's pretty criticized, the FATCA regulation, but they have no choice. They have to comply with it. Is this clear?
Yes, ma'am.
Yeah, write this down. Done?
no, ma'am.
Done now?
Yes, ma'am.
Okay. So next thing we're going to talk about is risk management. So what is risk? What is risk? Guys, what is risk?
Possibility of loss.
Unpleasant situation in the market. Which is
Risk is what? Anything that would possibly lead to a loss, right? Danger, injury, etc.
Yes, ma'am.
Right.
yes, ma'am.
Do we face risk in our everyday life?
Yes, ma'am.
Yeah. So what is risk? It's a possibility or chance or danger or injury. Sorry, just give me a second. In terms of your financial markets, it's the possibility of losing money, losing the business, markets performing bad that could lead to a loss, right?
Yes, ma'am.
Okay. So we have risk and we have something called as uncertainty. Risk is more commonly also called as a known unknown that can be measured and quantified. Whereas your uncertainty is an unknown unknown that can't be measured or quantified. So to put it in context, let's say if you have to pick your friend up from the airport tomorrow and you're going to use your car, what are the possible risks you might face?
Roads under construction.
Roads under construction. What else?
Ma'am, car damage.
Tire puncture.
Tire puncture. What else?
Traffic.
Traffic. What else?
Ma'am, we get delayed.
You get delayed. Okay. What else?
And card are not active, ma'am. Maybe over limited. Already we used all the amount of
Card.
funds.
I'm not saying card, Monica. I'm saying car. Four-wheel car, vehicle. Okay. What else?
And fuel gets.
Fuel gets over. These are the risks that you know that you can face, right? Or you know of. Yes.
Yes, ma'am.
What can you do in order to avoid this risk? Let's look at it one by one. One said traffic. So you might get delayed because of traffic. Now we have all of these Google Maps or everything. You can find an alternative route which would give you less traffic, right? Yes or no?
Yes, ma'am.
Yes, ma'am.
Someone said fuel might get over. So what you'll do? You'll check your car if there's enough fuel, you'll fuel up, right? Before you go. Correct.
Yes, ma'am.
If the car tire is punctured, you have a spare tire in the boot of the car, right?
Yes, ma'am.
Yeah. Flight may getting delayed, you can check up the flight status when it is landing and all. So all of these are risks that you know of that you can quantify, measure, and you can put in controls or measures in place in order to avoid these risks, correct?
Yes, ma'am.
Yes, ma'am.
Yeah. What is uncertainty? So let's say you've done all of these checks to ensure everything is fine, your car is parked. Next day morning, you wake up, you're walking towards your car, and suddenly a meteorite falls on your car. Could you have predicted that?
No, ma'am.
No, right? So that is an uncertainty. Is this clear to everyone?
Yes, ma'am.
Yes, ma'am.
Okay. So what are the major types of risk in your financial world? We have market risk, we have credit risk, we have liquidity risk, and we have operational risk. So write this down. Okay. Another thing. So what is systemic risk can be further classified under something called as systemic risk and unsystemic risk. So what is systemic risk is it will affect the entire market. Like for example, your 2008 crisis, the pandemic that happened, it didn't affect a certain sector of the market, it affected the entire market, right? Yes or no?
Yes, ma'am.
That is called a systemic risk. What is unsystemic risk or unsystematic risk, which is also called as diversifiable risk, is it affects a certain sector of the financial industry or certain sector in the market. For example, a couple of years ago in India, we had this aviation industry took a hit, right? Do you remember that?
Yes, ma'am.
Yeah. All right. So make a note of that as well. And then let me know once you're finished writing, and we'll discuss what is market risk, credit risk, and liquidity risk and operational risk. Done?
1 minute, ma'am.
Sure.
Done, ma'am.
Okay, so let's look at what is market risk, right? So market risk is the possibility of an investor losing money due to factors that will affect the overall performance of the financial market, right? So market risk is also called as systemic or systematic risk. It cannot be eliminated through diversification, but it can be hedged in some ways, right? So to put it like in context, if you're owning shares, the risk for you is if the share for price falls, correct?
Yes, ma'am.
Yes, ma'am.
Yeah. So you can either enter into forwards or futures contracts and hedge your risk. Yeah.
Yes, ma'am.
Yes, ma'am.
Yes, ma'am.
Okay. Sources of market risk include recessions, political turmoil, changes in interest rates, natural disasters, terrorist attack. The most recent example that we can give is your war in Russia has caused market risk, right?
Yes,
Yes, ma'am.
Yeah. So systematic or market risk tends to influence the entire market at the same time. And then you have unsystematic risk. It is unique, specific to a company or industry. It's also called as non-systematic risk, specific risk, or diversifiable risk, or residual risk, right? So in terms of your investment portfolio, your unsystematic risk can be reduced through diversification. Like we don't, any wise fund manager will never tell you to put all of your money into one particular market or one particular investment, right?
Yes, ma'am.
Yeah. Are we clear with what is market risk?
Yes, ma'am.
Yeah, write
Yes,
that down. Then we'll discuss under market risk, what is interest rate risk, equity risk, and all of the others. Here we go. No, Satya, other way around. Systematic risk cannot be completely eliminated. Unsystematic risk can be because it's more specific to a specific industry, right? Whereas systemic risk affects the entire market. It's not specific to a specific sector or industry. Done?
No, ma'am.
Right. So let's look at the main types of market risk. We have interest rate risk, which covers the volatility that may accompany the interest rate fluctuation due to fundamental factors such as central bank changing or making announcements related to the change in monetary policy. And this risk is more directly relevant to your fixed income securities such as bonds. Why? Why? Why?
Accrued in
Accrued interest.
Open payment.
Okay, what else?
Ma'am, because they are related to fixed interest income.
What's the relationship between market interest rate and price of bond?
inversely
They are
proportional.
inversely proportional.
Now, do you understand why this risk is more relevant to fixed income products? Yes or no? Okay. Then we have equity risk, which is a risk involved in changing prices of stock investments, rise and fall of your prices of shares in the market. Commodity risk, same rise and fall in the commodities prices. Currency risk or exchange rate risk, which is your change in the exchange rate of one currency versus the other currency. So sometimes investors or institutions might hold assets in another country that would be subject to currency risk. Is this clear?
Yes, ma'am.
Okay. How do we measure market risk? So market risk is used, or rather investors or analysts use something called as the VAR method, which is value at risk. Now we don't teach how this method is used in class. That is for your FRM courses or your CFA courses. The VAR modeling is a statistical risk management method that quantifies a stock or a portfolio's potential loss as well as the probability of that potential loss occurring. Is this clear?
Yes, ma'am.
Okay. Through this, though this may help you for to determine the risk in a short term, this thing, but as a long term, it is not an accurate measurement. Is this clear?
Yes, ma'am.
Yeah, write this down.
Ma'am, can you please scroll up for a moment? Thank you, ma'am.
Done?
No, ma'am.
Done now?
No, ma'am.
Done now?
Yes, ma'am.
Sorry, was that a yes?
Ma'am.
Okay. Next is your credit risk. So what is credit risk?
Ma'am, 1 minute. Thank you.
Done. So next we have is credit risk. So credit risk is the possibility of a lender taking or rather lender facing losses due to the possibility of the borrower not paying back the loan. So your consumer credit risk can be measured by 5 C's, which is the credit history, capacity to repay the capital, loans conditions and the associated collateral. So if you walk into the bank and you say you want a loan, they're just not going to give you a loan like that only, right? They'll do certain checks, correct?
Yes, ma'am.
Yeah.
Yes, ma'am.
Right? So consumers posing a higher risk or higher credit risk usually end up paying higher interest rates on loans. To reduce the lender's credit risk, so lender may perform credit check on prospective borrowers, or they might ask the borrower to take out appropriate insurance, or like maybe put up their houses as mortgage, or they might ask for collateral. You all know what is collateral, right?
Yes, ma'am.
Yes, ma'am.
Yeah. So that is your credit risk. Liquidity risk is the ability, or liquidity is the ability of the firm or company or even an individual to pay its debts without suffering catastrophic losses. So investors, managers, creditors usually use liquidity measurement ratios to decide the level of risk within an organization. If a institute or entity or individual cannot meet its short-term liabilities, then they would be facing liquidity risk. Is this clear to everyone?
Yes, ma'am.
Okay. So how do you mitigate your liquidity risk? You identify the liquidity risk early, monitor and control the liquidity regularly, conduct scheduled stress tests. You know what are stress tests now. We discussed that under Basel, remember? Yeah. And create a contingency plan. Have you heard of this word contingency?
Yes,
No,
ma'am.
ma'am.
Yes, ma'am.
Ma'am.
So contingency plan is a plan that will come into place if any risk gets triggered or if any issue arises. So to put it in context, whenever, or rather to tell you a live example of it, when I used to work in Goldman, we used to have something called as a BCP, which is Business Continuity Plan. So this got triggered when back a couple of years ago, there was this couple of bombings that happened in Bangalore. I don't know if you guys would remember or know about it. And that was somewhere within the city. So the office that was there of GS, it was within the city limits. So they triggered the BCP plan, which would make the employees not work from that office. They had opened or built another outskirts of the city, somewhere far away. They built offices where they had the people go to those offices and work from there. So it wouldn't affect the continuity of the business. Another example I can give you is, I think 2, 3 years ago, there were big floods in Chennai, and you have your investment banks such as BNP, Barclays, etc. in Chennai. They had moved their employees to Bangalore temporarily to work from Bangalore so that the business would continue. Are we clear with what's a contingency plan?
Yes, ma'am.
Yeah, so write down what is credit risk and liquidity risk and let me know once you're done. Done?
No, ma'am.
Done now?
No, ma'am.
Done, ma'am.
Yes, ma'am. Someone said 1 minute, so we'll give it a minute.
Done, ma'am.
Okay, so let's look at the operational risk. So what is operational risk? So operational risk summarizes the chance or uncertainties of a company faces in the course of conducting its daily business activities, procedures, or systems. So it's heavily dependent on human factors, right? So for example, let's say if you walk into work and your system is not working, that could be system issues. You cannot do your job. Yes? Yes or no?
Yes, ma'am.
Yeah.
Yes, ma'am.
If you're inputting, or let me put it this way, in your trade life cycle, which stage is manual? Manual meaning you do some
Capture stage.
capture,
Execution.
exactly, capture stage. Your capture stage is manual, where the trader is inputting the details from the trade sheet into the order management or risk management system, correct? Yes or no?
Yes, ma'am.
He can make mistakes when he's capturing the data on the system.
Yes, ma'am.
Yeah. What other stage is there in trade life cycle which is put in place in order to catch if there are any mistakes?
Verification.
Very good. Verification stage, where we compare the trade sheet versus your order management and risk management system, right? Why do we do that? I say no, it is a risk procedure or risk control that is put in place to ensure that a trader, what he's mentioned in the sheet, that is captured in the system. Is this clear? Is this clear? Yes or no?
Yes, ma'am.
Yeah. So type of business risk or operational risk is also called as a type of business risk, but it can be distinct from your systematic and financial risk, right? So how do you mitigate your operational risk? Again, you identify what are the risks. Like in your trade life cycle, we identified the risk is manual inputting of the details on the system, assess the risk, and then make risk decision, implement the controls, supervise and watch for changes. Is this clear to everyone?
Yes, ma'am.
Yeah, write this down. Done?
Yes, ma'am.
Everyone's done?
No, ma'am.
No?
Done, ma'am.
Okay, take down questions for your reg environment class. So it can ask you what is EMIR, what is MIFID, what is FATCA, what is Basel, what is Wolfberg, what is Egmont. So basically the questions can be from there. Is this clear? Okay. From risk, it can be what is risk, what are the types of risk, or then can be specific or say, can you explain what is market risk, uh, liquidity risk, credit risk, operational risk. Okay.
Ma'am, I can't see the screen.
Because I have not written questions down.
Okay.
on that.
Please repeat once, ma'am.
Sure. So for reg environment class, the questions can be what is MIFID, what is Egmont, what is EMIR, what is FATCA, what is Frank Dodd. Basically, what all we covered, what are those? Okay. For risk management class, it will be what is risk, what are the types of risk, or might be more specific than saying asking what is market risk, what is operational risk, what is liquidity risk, what is credit risk, what is operational risk. Okay. All right. So are there any questions? So next week, you guys will have a guest lecture, you will have your presentations, and you'll have a final refresher, then you'll get a revision holiday, and the week after that will be your final mocks. Is this clear?
Yes, ma'am.
Okay. So those of you who haven't studied, start studying. I'll be publishing these scores today, right? Your level 2 scores. I'll send it out in a few short minutes. All right.
Okay, ma'am.
Yes, ma'am.
Thank you, ma'am.
Thank you. If there are no other questions, can we wind up for today then?
Yes, ma'am.
Okay then. See you guys next week. Have a good weekend.
Same to you, ma'am.
Thank you.
Thank you, ma'am.
Thank you.
Thank you.